Okay, so very good morning to everyone. It is Wednesday the 10th of January. I hope everyone is well. We're going to go straight into the briefing and going to have Sam North, our senior market analyst, is going to come on as well and say a few things about the market more technically. So I'll cover off the fundamentals and what's going on at the moment. Particular focus this morning about the US 10-year yield having breached 2.5% on the upside for the first time yesterday since I think it was 9 months ago. It's around March last year. So we'll have a look at some of the reasons behind that and why that is occurring, and we'll also look at some of the other news stories in focus this morning. First things first though, just before I did switch on my mic to commence this briefing, we've just seen a bit of price activity in the DAX on little in terms of actual headline news flow, it seems. One thing is putting the DAX on a minute from the open. First of all, we did come under some pressure. Last time I came on the mic about 20 minutes ago, you can see we broke that lower support point, which was tested a couple of times. Short term, of course, this was in the futures pre-cash open, and then post that came on the third test, an eventual break and a run lower. But we've already reversed that, and if anything, we have just briefly broken the initial gap down that we had from the open of Eurex at 7 AM this morning. A brief look above there, but nothing sustained as yet. So haven't had a gap fill as yet, but something to just monitor. Again, nothing really fundamental in that last little move. It does come though with US equity markets, of course, finished in positive territory. The statistic now is the S&P up for the 6th consecutive day, so marginal gains, albeit, so up 0.13%. A record though, 6 days in a row to start a year, only matched at the start of 1964 and 2010. It's only been beaten and gone to 7 days back in 1976 and 1987. If you think 6 days in a row is quite a lot though, check out the Hang Seng in Hong Kong. It's just put in its 12th consecutive day of gains, which is a record as well in the Asia-Pac markets. So quite a few other markets as well as a prominent theme globally, not just for the US indices, with that being said. I'm going to jump straight into this US yield story then. And first of all, let's just have a quick look at the chart here. This was the US 10 years performance from yesterday, and as you can see, a pretty decent move. We went from around where we were kind of market open price levels around 123.14, and we went all the way down to a late Asia Pac low, European entrance low down at 122.27. So a pretty decent move, and what overall now starts to move into territory of which we were looking at very much so at the end of last year as a real credible threat to, is the bond market going to be one of the main catalysts for the next kind of focal point for market volatility and activity as we go through the next 12 months. So just looking at the US 10-year here on a weekly continuation chart, you can see here we have just below that point of late 2016, and then going back to the midpoint, what would be 2014, kind of the tail end of 2013, the beginning of 2014. Any break below here, obviously from a technical point of view, starts to look very interesting because their next price points are not for some way down until we get another 1.5–2 points lower. But a few things to bear in mind when understanding why this is occurring, and this is one of them. Traders in the fixed income market will pay very close attention to the actual yield in percentage terms and what it's trading. And one thing that happened yesterday that was significant is that you can see how 2.5% has been a big barrier in the US 10-year. That occurred really just before the run-up into Christmas, in kind of mid to late December, hit that level, but then failed to breach. But already this morning, well, I should say day 9, 10 of this year, we've managed to get our head firmly above that price point. So again, going all the way back to where we were in excess of 2.6, it would be March of 2017. So why is this occurring? And I've put together a couple of bullet points here. I thought I'd put it on a document to make it just easier for you guys to understand what's going on. So first of all, 2.5%. Why is this significant? Well, just looking at this trend here on a longer time frame going back into the late 80s. This is quite neatly put together by our friends at Deutsche Bank. But you can see here on these trend lines that we're just about to break out of this channel at this 2.5%. Hence the reason why it is so significant, because we've been locked in this price band for such a long period of time. Other considerations, and there are several, of why this is occurring. One is rising oil prices. I mean, we've seen an extremely robust response really in the last 3 months in the price of crude. We've gone from, if I flip over my charts to here to look at crude on a longer time frame, we have gone from where we were kind of October time when the market was gearing up, 4 weeks after that for the end of November OPEC meeting and the roll over an extension of the OPEC non-OPEC deal to be extended throughout this year. That, amongst other factors we've discussed before, the global economic picture just picking up in terms of global growth expectations and so on, and therefore net demand picking up, as we've seen in recent forecasts being upgraded on that front. And oil now breaking above also, similarly, a key technical price point back at the beginning of 2015. And here we are surging further above that. We did have the inventory numbers last night, which I'll get around to shortly, but they were also extremely bullish for prices, and we've accelerated that move. But the point being is that from where oil has been locked in around a 55 top of the price activity for much of 2017, we're now continuing to push higher. And obviously this fits the narrative of the expectations that eventually inflation should start to pick up in time. So that's one reason. Another reason, of course, is the expectation, and this is what the Fed have been continuing to tell us as market participants, and that is expectations of rising inflation on a tightening labour force. Now, although non-farm payrolls was a touch disappointing that we saw last week, it doesn't really detract from the situation that the employment picture in the US is improving and is fairly robust. Unemployment levels are relatively low. The problem is then at what point does this start to translate into increasing inflation? And as far as the Fed are concerned, they are comfortable to continue on with their rate hiking cycle. Of course, they are telling us that they're going to hike 3 times on the back of they foresee inflation starting to rise. Rising inflation expectations means higher yields. The other thing that's going on, although it's certainly not in any big size at all at the moment, quantitative tightening, QT. Don't forget, this did start back in October. And this is the unwinding, if you like, the tightening of the balance sheet that swelled over the 3 phases of quantitative easing, which have been factored in over the US over the last several years, taking their balance sheet from about 800 billion all the way up to 4.5 trillion. Now it's about slightly removing some of the punch bowl, if you like. So this is ongoing, and as the Fed have told us at the end of last year, the amount of bonds they're going to let mature, i.e. the aggressiveness of the tightening, is going to be incrementally getting larger and larger over time throughout this year. So that is going on. The other thing, of course, is the big theme so far this year. As we mentioned, we're off to record-breaking almost starts for consecutive gains in the equity market, busted through 25,000 already in the Dow in the first week of trade. Equity markets, many people still remaining ultra bullish at this point. Calls of 3,000 now in the S&P definitely sound more than reasonable, if not, a lot of calls going even higher. We're only 250 points away from there at the moment at current price. So equity markets also continuing to push higher. Then you've got what was, I would say, more of a catalyst than a real contributing factor, but it certainly, you've got to put it in context of the fact that the Bank of Japan are ultra dovish, and what we had yesterday from them was a subtle shift in the purchases of their bond buying program. Although it's not interpreted as an imminent shift from their ultra accommodative policy, it is just another sign, though, that central banks as stepping back from the global bond market. You know, the other central banks, as we just mentioned, such as the Fed, the ECB, the same, incrementally decreasing their volume of purchases on a monthly basis. This did catch quite a few people, the Bank of Japan story from yesterday, by surprise, and I think this, if anything, was a bit of a catalyst for this break of the 2.5 and some of the attention that it's drawn this morning. The other thing as well, and just to go over this quickly, specifically for this week in terms of timing, is primary issuance. So by this, what I'm talking about is sovereign and corporate issuance. When there's an excess amount of supply but an equal amount of demand, let's say, well then prices have got to fall. So bond prices got to fall, yields are going to rise. It's kind of the summary of the price movement as a function. And so this week in particular, there's around $60 billion of combined issuance expected from sovereign deals from the US, Japan, Germany, and the UK. So these are government bond auctions. While there's 20 billion also of European corporate issuance expected, with investment grade issuance in the US adding another 14.7 billion. So you've got a large amount of corporates coming to market to raise debt, of which there's a large amount of investment grade, and so this detracts then from people looking at, say, a traditional bond market. They look elsewhere, investing into the corporate issuance instead, and so it decreases demand in that sense, and bond prices come under some pressure as they kind of anticipate this incoming supply. And then the final thing is, you probably read this morning a number of the big fund managers talking down the bond market. You've had Bill Gross said that yesterday a bond bear market has been confirmed by this break that we've had in the yield on the upside through 2.5%. And Jeffrey Gundlach, who's a big investor in the States, he said markets are not priced for the shrinking of the central bank's balance sheet. And so this now is a movement in preparation of the market repositioning itself for that reality. So yeah, lots of different things all coming together, I think, is what contributed to a lot of this move, both technically, as you can see here, and also as a function of lots of different things, from expectations over inflationary read-acrosses, so from oil prices and the labour force, but then the persistent gains in the equity market, to monetary policy action in the form of QT and the BOJ's slight shift in their purchasing, their regular bond buying operations. So hopefully that makes a bit more sense as to why people are talking about this a lot this morning. Okay, a few other things though I want to quickly touch upon, then I'll hand you over to Sam. And one is the movement in oil prices more short term, because as I did mention, just looking on a longer time frame here on the daily, we are now above quite a key technical point of 2015, which does, we've been talking about this already since we've come back for 2018, about the fundamentals still lining up to be more bullish crude prices. And if we get a technical break, of which has now occurred, does this open up a further push for crude going forward? Well, last night we've had another big surge in prices, and in particular I want to highlight this candlestick here, which took us up through the 63 handle more firmly, and we sit there at 63.50 this morning, and we're up about 50 cents on the session. And so this is the type of headline that you're seeing this morning. Oil marches higher, signs of a massive drop in US stockpiles. So what are they referring to? They're referring to this. So this is from Zero Hedge. There's actually a slight typo here. This is minus 11.19 million. So there was a drawdown last night in the headline API crude oil inventory, a drawdown of 11.19 million. Expectations were for a drawdown of 500,000. So way bigger drawdown than expected. In fact, the biggest draw we've had since September of 2016. Cushing, a drawdown larger than expected again, 2.156 million. The only one bucking the trend really with gasoline distillates. Gasoline was a slightly larger build and fairly chunky size, 4.685 million. But that was a real standout on the headline figure, which has prompted this next push higher in the price of crude oil this morning. So be very interesting to see. Of course, we'll get the Department of Energy numbers later on this afternoon. Okay, so just want to have a quick look over the calendar, and then, as I said, Sam will jump on and look at some of the setups for this morning and interesting levels that he's looking at. Looking at 9:30, you've got the UK construction numbers, manufacturing industrial output figures, and trade balance. Now, I know this sounds interesting and it sounds potentially market moving. I'd say on a normal basis, normally these figures don't have that level of impact, but nonetheless, I do think it warrants monitoring, and I don't think it's worth carrying a position if you are contemplating it over the figure, or at least lightening those positions if in fact you are already in. So that's at 9:30, and then going further into the afternoon, import-export prices from the US. Pretty light again. As I said, the one really key interesting thing is, talking about the movement in the US 10-year yield, you've obviously got a lot of attention being paid by the market to inflationary conditions in the States, and of course we get that US CPI reading, which is pretty much the biggest event scheduled for this week. So that'll be on Friday afternoon alongside retail sales, of course. And then to wrap things up, we get the oil inventory numbers from the Department of Energy at 3:30. A couple of speakers, Fed's Evans and Fed's Bullard, coming later on today. Okay, let me hand you over to Sam, and then he can pick up on a few other things. Thanks very much, guys.
Yep, hi guys, as Ant said, just going to run over a few of the charts from a technical point of view. So if I just open up one of these, and we can run through, starting off with the currencies. Just remove everything on here. So we'll start off with the euro. So we've just seen, albeit not massively, the dollar slightly weakening over the last sort of half an hour, and you can see euro actually sitting on quite an interesting point, just below 120, just gone through the high of the day. And I think if we can get up to this area and about a circle here from the Friday evening close, Monday morning low, could find some quite good resistance around here. You see I've just circled up on the chart there, so it's a bit of a weaker dollar this morning, but if we can get to this point, it could be quite a nice area to perhaps continue this downtrend that we've seen from the beginning of this weekend, end of last. Important support area, yesterday's low, just above the S1 as well. I definitely would say something to be aware of. The main mover from overnight, the yen, you can see here just circling this area, quite a bit of strength coming in, and this low that I'm just about to mark up here, I'm just going to longer the time frame, you can see how important that has been. So that was exactly, well, pretty much to the tick, the low of the 15th of December there. So it would be quite interesting to see if we can get down to that level again, and if we were to break on through, just going to make the chart even smaller, you can see the 6th of December also offered some good support around there. Below there, if we were to get a further move perhaps into the afternoon or later in the day, you can see it opens up quite a bit of room to the next sort of strong support area down here on the 1st of December. So quite an interesting chart to have a look at there for the yen. Levels that we could get a retracement to perhaps continue the downtrend we've seen this morning. You've got the low of the 2nd just circled here, and previous days support levels, obviously now resistance points to be aware of. In fact, we did have the classic short there off the 3rd of January breakthrough, come back, so definitely a currency pair to be looking at today, which has sort of already had the most movement on that. Switching over to the pound, as you see here, obviously you've got some data out at 9:30, albeit November data, so not expecting too much from that, but probably wouldn't want to jump into a trade around about now. Good area of support, 135.23, pivot, good area of resistance, and it's sort of contained within that. S1 today with yesterday's low, good area of support, so between 23 and 32 to the downside here should offer quite good support if we wanted to see a continuation of this late December trend to the upside, albeit we have started to range a bit now, and you can see that sort of triple top around R1 today as well. Not saying we're going to get up to that point, but would certainly offer some good resistance as a place where people would look to take profit, considering every time we have been up there we have come down quite sharply. Aussie dollar stuck in a bit of a range yesterday, as you see here, looking quite choppy now, but we just, as of about sort of 10 minutes ago, just broke through that pivot to come to yesterday morning's high, just circled here, and you can see we found good resistance on that point. So interesting area for all the sort of dollar related markets other than pound at the moment, so it'd be interesting to see if we can see a weaker dollar and see a continuation through, or this is the turning point and we get another test of those lows later in the day or afternoon. As Ant mentioned, oil obviously pushing on quite a bit last night. We briefly made a new high for today, and we're just sort of ranging between the sort of overnight low and morning high now. I did post into Trading Live chat, and you can see here, if I make this chart quite a bit smaller, so I do appreciate it might be hard to see, you've got the low of this week here, the 24th of December 2014, 63.72 for the futures is definitely a level worth having on today. As you know, you usually get to these levels we haven't seen for quite some time. 63.73 we'll have to do for now. I would definitely be looking to have on that chart for a potential resistance area. The May or 2015 high yesterday we saw in oil really did get pushed through quite strongly, so I'd definitely be focusing on 63.72, see if we can see a similar level of resistance broken. Obviously the data later today, 3:30, would be the main sort of driver following the API. Equities this morning coming down quite strongly, and actually the classic for both the S&P and the Dow off what was the low of the morning. If I just lower the time frame down here, you can see broken through here, retrace back, and then the classic from that low worked very well for the S&P. The Dow Jones as well, if I just show you here, broke through the lows of the morning, came back, test, and a good point in the market to go short, and we're actually just coming back down to test the low of the morning, which obviously would be a good place to take profit. Carry on, push through here, and then you can start getting to yesterday's levels. The buy the dip mentality, I have to say, is still going to be about, so looking for possible places to get in if this down move was to continue. Dow Jones, yesterday's lows, S1s look not too bad. S&P, you've got yesterday's low just above S1, which also looks quite tempting. The Nasdaq, which had quite a big sell-off on that cash open yesterday before recovering, also looks quite good with yesterday's low not too far away from that S1 area. Just finishing up on, or actually just before we finish up on gold here, you can see just briefly going above the pivot, and again I did post into Trading Live, I had this brief sort of trend line on, didn't get hit. It's not going on there, but just to see if it had been respected. Not just yet, but we did break above that high of the day, so of course this point in the market now could well become a level of support if we were to see continued weaker dollar, where people might want to get back into the market. The Bund, for those Bund traders, if I just put this onto that weekly time frame here, and you can see how important, if I just remove all these studies that we put on, just how important this level is from this sort of trend line here, just hitting the bottom of that now, so it'd be quite interesting to see whether we can get a continuation down and then start coming to these points in the market from last year, or if it offers support and we go highest from a technical point of view. Any questions about any of these charts, or whether it now or later, please get them in the chat. If not, have a good day, and I'll catch you around midday.